Hello students, welcome to class. Our topic for today is types of insurance. In our previous class, we've discussed about insurance and what insurable and non-insurable risks are, and we also discussed the principles of insurance. However, in this class, we'll be proceeding with types of insurance. In this class, students will be taught types of insurance, Underwriting, Reinsurance Corporation of Nigeria, and types of risks. So let's start with types of insurance, and the first one we'll be looking at is general insurance. Under general insurance, we have fire insurance. This type of insurance covers for fire incidents. Now, for example, if a person insures his building against fire and there's an incident of fire, the insurance company will compensate the person for the assets that was lost. Next, we have content insurance. Content insurance is a type of insurance or type of home insurance. It covers loss or damage to all the things that are in your home that aren't part of the structure of the building. For example, furniture, electronics, etc. The next is comprehensive insurance. By choosing this insurance policy, the insured can be well assured for fire, explosion, lightning, burglary, riots, etc. Next is consequential loss insurance. Consequential loss insurance is a type of business insurance related to losses to business property or equipment. For example, loss of rent. The next one is Moto Insurance. And under Moto Insurance, we have minimum legal cover. Minimum legal cover covers for injuries to third party on public roads only. Next is third party cover. Third party cover includes injuries and damages to properties of third parties in an accident. Next is third party fire and theft insurance. This policy covers for third party plus damage to car by theft or fire. The next is comprehensive insurance. Comprehensive insurance covers for third party plus damage to car by theft or fire. It also covers damage to vehicle, personal injuries to driver, and loss or damage of personal possessions while in the car. Next type of insurance we'll be looking at is accidental insurance. Under that, we have car insurance. This type of insurance covers for theft, accident, and third party. The next is medical policy insurance. Health insurance or medical insurance is a type of insurance that covers the whole or a part of risks of a person incurring medical expenses. The next is cash in transit insurance. Cash in transit insurance covers against loss due to robbery of cash in transit. And the next is workman compensation insurance. This insurance is compulsory for employers to insure their employees against any accidents during their work hours. The next type of insurance we'll be looking at is liability insurance. And under liability insurance, we have employer liability. This covers for accident at work owing to the employer's negligence. Next is public liability. This type of insurance is held to cover claims made by the public as a result of damage to their property or life. Next is professional liabilities. Professional liabilities are taken by professionals such as lawyers, architects, doctors, engineers, etc. to cover against claims due to their personal negligence. We also have insurance of interest, also known as Fidelity Bond. A Fidelity Bond is a form of business insurance that covers an employee it covers an employer against losses that are caused by its employees' fraudulent or dishonest actions. This form of insurance can protect the employer against monetary and physical losses. Next is life assurance. Under life assurance, we have whole life policy. Whole life policy is a type of permanent life insurance, which means the insured person is covered for the duration of their life as long as premiums are paid on time. As long as premiums are current, the policy remains active for the entire life of the policyholder, and beneficiaries will receive a set death benefit upon the insured death. The next is endowment policy. Endowment policy is a type of life insurance policy which provides the combined benefit of insurance coverage and savings. Endowment plans helps the insured to save regularly over a particular time period in order to have a lump sum amount at the maturity of the policy. We also have family income protection policy. This is a type of life insurance that will give regular financial support to the family of the policyholder if they die or they are diagnosed with a terminal illness. We also have mortgage payment insurance. This is an insurance policy that protects the mortgage lender or title holder if the borrower defaults on payment, passes away, or is unable to meet the contractual obligation of the mortgage. It pays off either the lender or the heirs depending on the terms of the policy. And we have group insurance. This is taken by small employers for employees in place of pension scheme for their employees. The next type of insurance we're looking at is marine insurance. Marine insurance covers for sea or water transport, that is the goods and the passengers. It covers for the ship and its installation, it covers for the passengers, also covers for the crew, it covers for the port, that is the seaport and its installations. It also covers for the cargo, that is the goods being transported. It covers for freight, and lastly it covers for public liability. And we also have aviation insurance. Aviation insurance covers for air transportation, while marine insurance covers for water transportation. And under aviation insurance, it covers for the plane, the crew, the passengers, port installations, that is airport installations. It covers for public installations. It covers for the cargo too, that is the goods being transported. Now let's look at types of risks. We've already established that insurance is used to cover against risks or to mitigate or reduce the impact of loss. So the types of risks are as follows. One is pure risks. Pure risks is a type of risk that holds out only the possibility of loss or no loss. For example, if you buy a new textbook, you face the possibility of it being stolen or not being stolen. The next is speculative risks. Speculative risks is a type of risk that holds out the possibility of loss, gain, or no loss, that is break even. Speculative risks are very common in business undertakings. For example, if you establish a new business, you would make a profit if the business is successful and sustain a loss if the business is unsuccessful. Looking at this, particular risks. A particular risk is a risk that affects only an individual and not everybody in the community. For example, if a textbook is stolen, the full impact of the loss of the book is felt by only you and not by the entire members of your class. Next type of risk is fundamental risks. Fundamental risks is a type of risk that is non-discriminatory in its attack and effect. It is caused by phenomena like inflation, bad economy, unemployment, wars, political instability, etc. Fundamental risks affect a large population, and in some cases they might affect the whole population, e.g. weather conditions like harmattan, rain, etc. Next type of risk is static risks. Static risks are risks that involve losses brought about by irregular action of nature or by dishonest misdeeds and mistakes of man. For example, if all economic variables remains the same, some people with fraudulent tendencies would still go out to steal, embezzle public funds, and abuse their office. The last type of risk we're looking at is dynamic risks. Dynamic risks are risks brought about by changes in the economy, that is, changes in price level, income, taste of consumers, technology, etc. This can bring about financial losses to members of the economy. Generally, dynamic risks are the result of adjustment to miscalculation of resources. For example, technological change which brings about a more efficient way of mass producing a higher quality of article at a cheaper price to consumers than was previously the case, has obviously benefited the society, etc. And before we end this class, let's look at underwriting. Underwriting is the process of agreeing to bear the financial risks in an insurance contract. The underwriter is called the insurance company. The insurance underwriters assesses the risk that is being insured. For instance, fire damage to a house, the possibility of a car being stolen, etc. And these underwriters receive premium from the property owners.
Now let's take a quick exercise. Question 1. List 5 types of risks. Question 2. Explain 6 types of insurance. Question 3. Differentiate between pure risks and speculative risks. Question 4. What does it mean to underwrite a risk?
Please, we've come to the end of this class. Thank you for watching. See you in the next class. Bye bye.